This is Sandeep Anand with Sand Compounding. Here is a new series I'm going to explain, and we are going to together get into different financial statements that we have in the annual reports. Every company or every business publishes on quarterly and annual basis the so-called 10K in US or annual reports in India or China. These are different financial statements that companies generate at the end of every quarter, yearly ones. Now we are going to get into finer details of what these annual reports comprises of. The first in line is something called as P&L as per the industry parlance. It's nothing but the profit and loss statement. Profit and loss statement, as the name says, indicates how well the company is doing in terms of their sales growth, how much sales they generated in the recent quarter or in the yearly annual report, how much profits they're generating. It's also called as the earnings report. Now let us take an example of a real P&L statement and get into finer nuances. We have to understand that we always need to look at a consolidated statements of income. Many companies have different subsidiaries under their businesses. In an overarching way, they put a consolidated statement of income or profit and loss, which is always the point of view for us. We should not just look at the standalone statement of income. So here is a consolidated statement of income of Walmart. So in this consolidated statement, you could see the revenues. Walmart generated close to $500 billion in 2018 as against $485 billion in 2017. So that's a net sales which falls under the revenue. And they also have membership revenue that's coming from many of their subsidiaries. For example, they have a subsidiary which is Sam's Club. So membership revenue is a significant part of Walmart's total revenue. So you put together $495 billion plus $4.5 billion together is $500 billion revenue they generated in 2018. And then comes the cost of expenses. So these are typical expenses to run the business. The topmost of the expenses is the cost of sales or cost of goods. They call it in industry terms COGS, COGS, and here it is $373 billion approximately. And when you subtract this cost of sales, the next step what you have to subtract is the operating expenses. So the operating expenses typically are combined along with sales, general and administrative. That is called selling, S general, G and A administrative. So it's called SG&A. So you reduce the operating sales, general and administrative expenses. You get an operating income of $20.4 billion in 2018 as against $22 billion in 2017. So here Walmart has degrown in operating income over 2017. The next component of expenses is the interest, which is nothing but typically businesses or companies take debt to put in their business to grow. So they have debt here, which is almost the interest on debt is almost $2 billion, which you could see the details of debt and things in the balance sheet, which we will take in the next section. You also see capital lease and financing obligations. These are nothing but Walmart typically rent on lease their operating spaces or their retail stores. Many of them they own it, many of them they lease it out. So they have a leasing obligation which is shown here, $352 million. And then there is a term called loss on extinguishment of debt, which is pretty much the amount that is a difference between the fair value of the payments made and the carrying amount of the debt at the time of closure or extinguishment of the debt. Now, when you reduce these components, you get the income before income taxes, and income tax is part and parcel of every P&L. Every company has to pay taxes, corporate taxes on the profits they generate. It's typically anywhere between 23 to 32% depending on the year you consider for the P&L statement. When you reduce the income tax here of $4.6 billion, we get a consolidated net income of $10.5 billion, which is significantly lower than $14.2 billion of profit that the company, that is Walmart, generated in 2017. The next is net income per common share. So you take the total earnings for the year and divide it by the total number of outstanding shares, common shares. You get weighted average or rather basic or diluted earnings per share. So this is called EPS, which is a very important factor for markets. Markets generally tend to compare the actual earnings per share to the expected earnings per share, and that's how the stock movements typically happen, which is lunacy. I mean, we don't really need to track at a quarterly or yearly level of EPS against expected EPS. Generally, when a company is generating consistent earnings, that itself, it's an indicator that the company is doing well. Now these are different components. Now I have put together, you see that the tax is 30% in 2018, and the profit after tax is approximately $9.8 billion. EPS is $3.28 per share, which is the diluted EPS. And you see the growth also you could calculate, which is an important thing to understand how the company is doing from year on year standpoint. So the revenue has grown pretty okay compared to how big the Walmart size is. It's almost generating $500 billion, so it's tough to grow consistently and larger way over such a huge base. So the revenue has grown around still at 3%, which is great, and the operating income growth is degrown by 10%. We will get into the details of why it is degrown, or rather the analysis of P&L as a next stage. The earnings also degrew by 26%, which again we will analyze why in the next sessions. So this is the overview of profit and loss statement in a quick nutshell, how to look at a P&L statement. Hope you found this video informative. Thank you.